Ever wondered how companies decide on the best mix of debt and equity for financing their operations? That, my friends, is the enigma of capital structure, a pivotal concept in the realm of corporate finance. It's all about striking the right balance to maximize value. Various theories try to demystify this equation, each offering a unique viewpoint. Among these theories, one stands out due to its unique perspective: the net operating income theory, or NOI theory. But what exactly is this NOI theory? Let's break it down. NOI, or net operating income theory, is a cornerstone of finance and capital structure theory. It was originally proposed by David Durand, an American economist, who postulated that the value of a firm is determined by its net operating income, not its capital structure. In essence, the NOI theory suggests that the value of a company is independent of how it finances its operations. Whether it raises funds through issuing bonds, borrowing from banks, or selling shares of its stock, the theory maintains that the value of the company stays constant. Now you might be wondering, how is that possible? Well, the NOI theory argues that a company's value is solely determined by its operating income. This income is generated through the company's business activities, such as selling goods or services. It's essentially the profit that a company makes from its operations after all operating expenses have been deducted, but before interest and taxes are subtracted. Here's a simplified way to understand it. Imagine you run a small business. According to the NOI theory, it doesn't matter whether you finance your business using your own savings, take out a bank loan, or sell shares to investors. What truly matters and what determines the value of your business is your net operating income, the profits you make from selling your products or services. In the grand scheme of things, the NOI theory proposes that the capital structure of a company is irrelevant when it comes to its value. The theory assumes that investors are indifferent to the debt-equity mix a company uses to finance its operations. They are primarily concerned with the company's net operating income. So, the cost of capital, irrespective of the debt-equity mix, remains constant. In other words, whether a company uses debt or equity to finance its operations, it doesn't affect its overall value. It's a bold statement, but that's what the NOI theory asserts. And it's this assertion that has sparked fascinating debates in the world of finance, which we'll delve into in our upcoming scenes. This might seem counterintuitive. After all, doesn't debt increase risk and therefore reduce value? Well, let's delve into some common misconceptions. It's often believed that more debt equates to greater risk and consequently a decrease in a company's value. This belief is based on the assumption that debt increases the financial risk of bankruptcy and financial distress. And while it's true that higher debt levels can increase financial risk, the net operating income theory, or the NOI theory, offers a different perspective. According to the NOI theory, the value of a company is not influenced by its capital structure, whether it's heavily debt-financed or equity-financed. Yes, you heard it right. The theory suggests that the rise in financial risk from debt is offset by the corresponding decrease in the cost of capital. How so? Well, debt offers tax benefits that equity does not. Interest on debt is tax deductible, reducing a firm's tax liability and thus effectively lowering the cost of debt. This reduction in the cost of capital counteracts the increased risk from debt. The result? The company's value remains unaffected by the capital structure. It's like a seesaw. On one side you have the increased risk from debt, and on the other you have the tax benefits. The two forces balance each other out, keeping the seesaw or the company's value level. But what about the shareholders? You might be thinking, surely they are the ones bearing the brunt of this increased risk. Well, according to the NOI theory, shareholders' required return doesn't change with the capital structure. The increased risk to shareholders is offset by the increased returns from the tax benefits of debt, so they too are left unaffected by the capital structure. In essence, the NOI theory posits that the capital structure is irrelevant in determining a firm's value. The increase in risk from debt is offset by the tax benefits, leaving the firm's value and the shareholder's position untouched. So, the NOI theory suggests that the firm's value remains constant, irrespective of the debt-equity mix. But hold on, this theory is based on certain assumptions, isn't it? Indeed, it is. The net operating income theory, or NOI theory, operates under a few key assumptions that we must unpack to fully grasp its essence. Let's delve into them. Firstly, the theory assumes perfect capital markets. What does that mean? It's a notion that all investors have access to the same information and can borrow or lend money at a risk-free rate. In such a market, there are no transaction costs or bankruptcy costs. This, of course, is a utopian scenario and doesn't precisely reflect the realities of the financial world. Next up, we have the assumption of no taxes. Now, any finance enthusiast would know that in reality, taxes significantly impact a company's financial decisions. Yet, the NOI theory presumes a world without corporate taxes, personal taxes, or any other taxes that could affect the cost of capital. This assumption allows us to focus on the relationship between a firm's operating income and its capital structure, without the tax-induced complexities. Lastly, the theory assumes a homogeneous expectation of investors. This means that all investors in the market have identical expectations about the future prospects of a firm, and they all agree on the risk and return of all investments. In other words, there's a consensus about the firm's future operating income and its risk, which, again, is a simplification that allows us to understand the theory without the noise of differing opinions and expectations. Now you might wonder, why even bother with these assumptions if they don't hold in the real world? Well, the answer lies in the simplification they provide. By assuming perfect capital markets, no taxes, and homogeneous expectations, we can isolate the impact of a firm's operating income on its capital structure, which is the crux of the NOI theory. While these assumptions might not hold in the real world, they help us understand the basic premise of the theory. So, what are the practical implications of this theory? Firstly, let's delve into the advantages of the net operating income theory, or NOI theory. Its simplicity is one of its greatest strengths. It distills the complex world of capital structure down to the basic principle that a firm's value is determined by its operating income and not by its mix of debt and equity. This straightforward approach allows businesses to focus on what they do best, operating their business efficiently and profitably. In addition, the NOI theory emphasizes the importance of operating income. It suggests that a company can increase its value by enhancing its operating income. This can be achieved through various strategies such as cost cutting, increasing sales, or improving operational efficiency. This focus on operating income is especially beneficial for firms that are in highly competitive markets or industries where profit margins are thin. In these cases, every bit of operating income can make a significant difference. However, the NOI theory is not without its limitations. One of the main criticisms is its reliance on a set of unrealistic assumptions. For instance, it assumes that there are no taxes and that the cost of debt does not increase with the degree of leverage. In the real world, these assumptions are rarely, if ever, met. This can lead to inaccurate predictions and misleading conclusions. Another limitation is that the NOI theory ignores the impact of financial distress. It assumes that the firm's risk is constant regardless of its capital structure. However, as a company increases its debt, it also increases its risk of financial distress, which can have a significant impact on the firm's value. Despite these limitations, the NOI theory provides a useful framework for understanding the indifference of a firm's value to its capital structure. It encourages firms to focus on enhancing their operating income, which can be a powerful strategy for increasing value. And while it may not account for all the complexities of the real world, it offers a starting point for further exploration and understanding. Let's wrap up what we've learned about the NOI theory. This theory, standing tall in the field of corporate finance, asserts that the value of a firm is not influenced by its capital structure. It's a bold claim, but one that is backed by a set of assumptions. We've learned that the NOI theory operates under the premise that the market is perfect, implying no taxes, no bankruptcy costs, and that investors can borrow at the same rate as corporations. While these assumptions may not hold true in the real world, they serve as a theoretical foundation, a starting point for understanding the complex dynamics of capital structure. We've also explored the advantages of the NOI theory. It simplifies the decision-making process for managers who can focus more on the business's operations rather than worrying about the perfect debt-equity mix. But Like any theory, it has its limitations. The assumptions it rests upon are idealistic and often don't reflect the messy realities of the business world. However, despite these limitations, the NOI theory offers valuable insights. It provides a new lens through which we can examine and understand the intricate world of corporate finance. It helps us appreciate that the value of a firm is determined more by its earning power and less by how it finances its operations. Remember, while the NOI theory provides a unique perspective, it's just one piece of the larger puzzle of corporate finance.